Welcome to the Vaughan Nelson podcast. Today is the first quarter 2026 Vaughan Nelson Small Cap Recap. And with me today is lead portfolio manager Chris Wallis. Welcome, Chris.
Thanks, Dan. Not unexpectedly, the quarter was dominated by really the macro factors at work. So I'll just jump right into those. First, the spike in oil prices and the closing of the Strait of Hormuz definitely represents a material headwind for the global economy. It'll have a bigger impact outside of the US, just given the excess capacity to produce energy within the US. And so the US should gain a bit of a cost advantage in the more energy intensive areas of the economy. Unfortunately, it does mean inflation should accelerate above 4% in the near term, which may in fact delay some opportunity we had as far as cutting rates. We'll see with the shift in leadership at the Fed that should develop over Q2. I would highlight, though, that should the strait remain closed for even a few more weeks at this stage, but certainly for months, or if there's any further damage to some of the energy infrastructure in the Middle East, then these issues in and around the availability of not just underlying oil molecules, but completed products, we're going to start to see elevated cost extend well beyond 2026, and we could see some rationing. So we'll need to continue to pay attention to that. The other thing that's really been kind of pressuring equity markets is what we're seeing is the downturn in the credit market. After nearly 15 years of an upcycle, it's turned down decisively. We've certainly seen within private credit an excess reliance on the retail investor. That retail investor is now asking for their money back, so we'll see pressure in redemptions. For the most part, this is going to be an issue within the private markets and within private equity, less so in public markets. It'll impact public markets, and we've seen the impact already, not just in the exchange traded BDCs, but we've also seen it within the alt managers. Certainly, some of these credit issues are going to show up in the CLO market, and we'll start to see them manifest within other areas of the financial sector in the public markets. But at this stage, I think it's going to be a long and drawn out recognition of these losses. It's going to have more to do with balance sheet capacity of investors to increase allocations to fund the refinancing that occurs over the next 2 years, but it doesn't look like it's anything systemic, but it'll continue to be something to worth monitoring. And then also we're at this peculiar period where the underlying liquidity regime was actually already peaking and rolling over. We're seeing the U.S. Treasury rebuild its checking account. It'll then flush those monies into the economy and into the market, probably beginning Q3 and into Q4, just ahead of midterms. So, what I would say is we expect continued choppiness. If we can see stabilization in energy prices and supply chains, liquidity conditions should improve in the third and fourth quarter. And that will help the market in the back half of the year. But right now, we still got some headwinds in front of us. From a portfolio management standpoint, I just say we're being very vigilant of the developing risk in equity markets. We're looking at, if I had to tilt it one way or the other, a little more towards capital preservation rather than increasing risk within the portfolio. And the way we do that is just ensure that we're aligning valuations with the underlying fundamentals. And we'll continue to take advantage of the market volatility to tactically improve the risk return profile of the portfolios. As it relates to activity within the quarter, as a result of buys and sales and market action, we saw a modest increase in the financial sector and materials sectors and a decrease in the tech sector and in real estate. And then for the quarter, we did experience positive absolute performance, although on a relative basis, we lagged the benchmark for the quarter.
Well, great. Well, thank you so much, Chris. And with that, we'll move to returns. In the first quarter of 2026, the Vaughan Nelson Small Cap Value Strategy returned 2.69% gross, 2.44% net, and the Russell 2000 value is at 4.96%. Over the past 1 year, Vaughan Nelson Small Cap Value returned 22.29% gross, 21.09 net, and the Russell 2000 value is at 28.09%. Past 3 years, Vaughan Nelson Small Cap Value returned 13.27% gross, 12.16% net, and the Russell 2000 value is at 13.8%. Over the 5 years, Von Nelson small cap value has returned 10.82% gross, 9.73% net, and the Russell 2000 value is at 5.79%. And last, over the course of the past 10 years, the Von Nelson small cap value strategy has returned 11.41% gross, 10.31% net, and the Russell 2000 value sits at 9.61%. And with that, that's a wrap on the first quarter. So thanks so much, Chris, and we'll see you again after the second. Well, thank you very much, Scott. And with that, we will move to returns in the first quarter of 2026. The Von Nelson Select Y share has returned negative 5.26%. The S&P 500 negative 4.33%. Past 1 year, Von Nelson Select Y share 13.63%. S&P 500 17.8%. Past 3 years, Von Nelson Select Y share 9.87%. S&P 500 18.32%. 5 years, 9.11, Von Nelson Select Y share, 12.06, S&P 500. Past 10 years, Von Nelson Select Y share, 12.52%, and S&P 500, 14.16%. With that, that's a wrap on the first quarter. So thank you so much, Scott, and we'll have you back here again soon.